What's up, YouTube? I'm back again with another Rolls-Royce update. This time I wanted you to hear it straight from the horse's mouth. I have a recording from the CEO and CFO on their future outlook and their progress this year. If you enjoy this video, please hit like and subscribe. I got a lot more content to come, so let's get right into it. By the way, I will leave a link to the transcript where you can follow along on your own.
And welcome to the Rolls-Royce Trading Update Call. Throughout the call, all participants will be in a listen-only mode, and afterwards there will be a question and answer session. And just to remind you, this conference call is being recorded. I'll now hand you over to Isabel Green, Head of Investor Relations. Please go ahead with your meeting.
Thank you, and good morning, everyone. With me on the call today are Warren East, CEO, and Stephen Daintis, CFO. We expect the call to last for around half an hour, including the prepared remarks, which will take 10 to 15 minutes. Before I hand over to Warren, I'm required to remind you that on the call we may make forward-looking statements and actual results could differ, as per page 4 on our press release. Thank you, and over to you, Warren.
Thanks very much, Isabel. Thanks very much, everybody, for joining us. I'll make a few opening remarks as usual. We're coming to the end of 2020 now. It's been a year that's completely unprecedented challenges. I think it's right to just have a quick reflect on our performance and some of the commitments that we've made for the years ahead. Going all the way back to the beginning of the year, we came in with good momentum, having turned a bit of a corner as we emerged from a extended period actually, of investment in new large civil engine programs, to be looking forward to a period where we would see higher returns, reaping the returns from that investment and our large installed base and increased market share that had been achieved. We were also on a position of solid growth in power systems and defence, with a particularly strong order book there. Then COVID. And an exogenous issue, nothing we could do about COVID. Our focus had to be on the things that we could control. And when the first wave of COVID hit, we took quick, decisive actions to conserve cash, restructure our civil aerospace business. By the time of our interim results, we'd already achieved approximately £350 million of in-year cash savings. And now we are confident that we will deliver our target of more than £1 billion for the full year. We've also made good progress with a more fundamental restructuring. In May, we announced at least 9,000 roles will be removed by the end of 2022. In October, we launched our £5 billion refinancing package that was necessary to increase resilience, to see us through this crisis, and strengthen our balance sheet, as well as support our long-term strategy. And we're very pleased to have concluded that process. We're also very grateful for the support that our investors showed us at that time, both with the equity raise and with the debt that it served to unlock. This means that we can now look forward with confidence that we have sufficient liquidity to get through this crisis, no matter how extended it is. Turning to what's happening in the business since we last gave you an update. In civil aerospace, our year-to-date large engine invoiced flying hours were at 42% of 2019 levels. We've been seeing a gradual tick-up in flying activity every month since April. October and November combined were at 33% of 2019 levels, and that was a trend up from 29% in Q3 and 24% in Q2. Meanwhile, our business jets have continued to perform relatively well, with demand much less affected by the pandemic. While the second wave of COVID-19 has delayed near-term recovery in air travel, it's very good to see the recent progress on vaccination. That's encouraging, welcome news. Flying looks likely to exit 2020 at a lower level than we expected. and that is likely to recover more slowly in the first half of 2021, but we still expect recovery then to accelerate in the second half as borders start reopening and economies pick up. We've continued to see the disparity in the pace of recovery for different routes and different aircraft. And in particular, we've seen improvement in flying hours in areas like China, where infection rates have been kept very low after the first wave passed, and travel restrictions have been reduced. We've also seen the fastest recovery on the younger aircraft, those programs that have the newer planes, things like the Trent XWB-97 on the A350-1000. That's already back to 2019 levels. Now, that's only a relatively small part of our installed base, but it's an indicator of what happens with our younger fleet. To preempt any later questions, by the way, on in-service issues on some of our Trent 1000 and Trent XWB engines, just a quick update there. We've completed our inspections of all high-cycle Trent XWB engines. We found early signs of wear on the first stage of the IPC blade in around 20% of cases, which is exactly the same as we reported in August. Most of these have already been refurbished, returned to the customers, and we have ample spares in place. The root cause investigation and testing is still proceeding, but it has progressed as planned. Onto the Trent 1000 in-service issues. We first achieved the ambition about zero aircraft on ground, clearly helped a little bit by the pandemic. But we have continued with the development work on the final fix for the HPT blade on the Trent 1010, and we remain on track to start installing that by the middle of next year. During the year, we have built sufficient spare engine capacity such that even if all those Dreamliners took to the air again tomorrow, we would be fine to maintain that zero aircraft on ground position. Our defence business has been largely unaffected by COVID-19 throughout. We've been able to keep all our facilities operational throughout, and demand has remained intact. We've benefited from very good support from our government customers, and 2021 revenue cover in our backlog is around 90% at the moment for defence. The recently announced multi-year defence budget increases in the UK, very encouraging. They're supporting the investment in next-generation capabilities, including the Tempest programme, and we're a core partner there. We've recently received an order from the German Air Force for 56 new Eurofighter engines, and that has benefited our defence business. It's also benefited ITP Aero. Our power systems business has been impacted by the pandemic, but much less so than our civil aerospace business. Some sectors and regions are holding up better than others. Again, a bright spot for us is China, where we have been growing market share, as you know, in recent years, and strategic relationships there have helped us increase our market presence. At a recent China International Import Expo, we announced provisional agreements with 6 Chinese companies for almost 1,000 MTU engines and systems, for instance. And our book-to-bill in power systems as a whole this year is getting to about 1. Demand from government customers in power systems has been resilient throughout, and we're starting to see early signs of recovery in some of the other end markets. Now, whilst the current year is important and the impact of COVID is important, it's also important that we keep an eye on the future and look ahead. And despite everything that has happened this year, we've been able to keep focused on our ambition to deliver more sustainable power. We know that society at large is at a pivotal moment in the drive towards a net zero carbon economy. And we think that Rolls-Royce has a key role to play. We're a leading British industrial technology company, and our key role is not only to do the right thing for ourselves, but to drive change through innovation in our products and services. We already make some of the world's most efficient jet engines, things like the XWB on the A350. That's the most efficient wide-body plane available in the market today. But as we look ahead to the future, we are investing in hybrid and electrical alternatives. In November, we ran ground tests to demonstrate that our Trent engines can operate with 100% sustainable aviation fuel, and that's an important piece of groundwork for industry-wide certification. To achieve net zero, society needs a huge step up in power generated from alternative sources like nuclear power. The UK government has committed £215 million for a 4-year development programme for our small modular reactor consortium. This investment in our nuclear energy solution will support the decarbonisation of power generation in the UK. But we've also signed strategic agreements with Exelon Generation and CEZ, highlighting the international appeal of our small modular nuclear reactors. Back inside the business, our key focus, as I said at the start, has been on controlling what we can control. And the restructuring that we announced in May, for instance, we've had to adapt to very challenging new reality as we look forward. And that has presented difficult choices about consolidating our global production footprint. We've had to make some very tough proposals after the last few months, but we can't afford to retain capacity where demand in the medium term has been so dramatically reduced. We announced a number of proposed changes for our civil aerospace business as we focus on reducing costs and positioning the business for recovery. Last week, we announced the proposal to transfer some of our structures and products manufacturing to ITP Aero, and further changes at some of our civil manufacturing sites to make them more competitive and reduce costs. These changes are in addition to the proposals that we'd announced previously about bringing assembly and testing of our wide-body engines back and consolidating in the UK, and consolidating our fan blade manufacturing into Singapore. It includes we'd already announced the closure of a manufacturing site in the US and a reduction to workforce in Germany. Now, this makes it a very difficult time for some of our people. We have removed more than 5,500 roles this year, but that has mostly been achieved through voluntary severance and early retirement, and that's helped us move ahead much more quickly with less uncertainty for our people. We're actively engaging with the trade unions, and those discussions are very constructive, but remain ongoing. So now moving on to our financial priorities, rebuilding our balance sheet, increasing our resilience, these are absolutely key to positioning the company for the future. When we launched our £5 billion recapitalisation in October, we made a number of commitments, and I'm very aware of the responsibility that that means we now have to deliver on those commitments over the coming years. Firstly, we're targeting more than £2 billion in proceeds from disposals. On Monday, we announced the agreement to sell our civil nuclear instrumentation and controls business to Framatome. This business, by the way, doesn't include any of our nuclear submarines activity or any of our SMR, small modular nuclear reactor activity. It generated around €100 million in revenue last year. It has a workforce of about 550 people across sites in France and the Czech Republic and in China. There are other assets under consideration for disposal, and we've talked before about ITP Aero, and we've also seen mention, and it's true, our medium-speed gas and diesel engines business, Bergen Engines, we're also looking to divest. We'll say more about these as and when it's appropriate to talk about them. So moving on to operational cash flows, we do expect to see free cash outflow in the region of £4.2 billion this year. It's an approximate guidance. The actual outturn is heavily influenced by timing of significant working capital cash flows around the year end, so we can't be more than approximate at the moment. And in particular, there are some issues around OE concession payments, which depend on the timing of new aircraft deliveries to airlines, and these are outside of our control. This guidance, however, I'll remind you, does include £1 billion of negative impact from the cessation of invoice discounting that we talked about with our half-year results. It also reflects the huge effort group-wide to save more than £1 billion of in-year cash costs. As a result, we expect overall our year-end net debt position to be around £1.5 billion with liquidity of around £9 billion, which is enough to see us through the crisis, even in a reasonable worst-case scenario. Our primary goal from a financial standpoint is to get the business away from consuming cash as soon as possible. We're targeting reaching break-even at some stage during the second half of 2021, primarily driven by our reorganisation programme. Now, the exact timing, will also be a little bit impacted by the pace of recovery in engine flying hours. If the recovery is slow, it might be a bit later in the second half. But we're going to do our best to get there as soon as possible. The other key financial objective is to generate at least £750 million of free cash flow as early as 2022. And of course, that is linked to the pace of market recovery, but it does include headwinds like Trent 1000 remediation costs, foreign currency exchange right-sizing on the hedge book costs that we talked about earlier this year, and obviously, as we look forward into the future, those one-offs will disappear. So 750 million remains firmly within our sights in that time period. In the medium term, our restructuring will enable us to be a leaner, healthier business, stronger operational gearing than we would otherwise have been, and well positioned for a recovery in revenue. 2020 has been a very tough year indeed. There's still a lot of work to be done in 21, but we think the fundamental drivers behind our business remain intact, and we can see structural and strategic growth opportunities across all our core businesses. I've talked long enough, so I'll pause now and we'll answer your questions.
Thank you. If you do wish to ask a question, please press 01 on your telephone keypad. If you wish to withdraw your question, you may do so by pressing 02 to cancel. There'll just be a brief pause while any questions are being registered. Our first question comes from the line of George Zhao from Bernstein. Please go ahead.
Hi, good morning, everyone. Warren, you said in the past that there has not been discounts on the flight hour contract prices. So when operators are under the service agreements with you, it may be more difficult for them to cut back the cash outlay. But how do you think about the downside of that, right? I mean, where elsewhere do you envision potential pressure either now or in the future as operators are still very much under pressure to cut back maintenance? And we've seen that where they have flexibility under time and materials model elsewhere, they have been doing exactly that, to cut maintenance. Thanks.
Well, look, I think what we've said before is that as far as invoicing during 2020 is concerned, then the contracts are in place, and we've tried to be reasonable with our airline customers in terms of rescheduling payments and the like, and we've tried to be reasonable. On a forward-looking basis, as airlines seek to resize their fleets, and there'll be some airplanes that get retired and other airplanes that get flown, we'll do our best to maintain our flying hour rates, but where it's necessary to have a trade-off between offering temporary discounts on flying hour rates in order to keep our aeroplanes flying rather than somebody else's, then we'll work with airlines and with leasing companies to come up with sensible commercial win-win packages. And our flying hour rates are a portion of the costs, but they're by no means the only costs for an airline. There's the financing cost and many other operational costs. So our rates are a very small part, actually, of airline operating costs, but we recognise we've got a part to play in that.
All right, thank you.
And the next question comes from the line of Andrew Gollan from Berenberg. Please go ahead.
Hi, guys. Thanks for taking my question. A couple really from me. Firstly, on the engine flying hours, indicated at 70% down in Q4 roughly. You mentioned, Warren, within your prepared remarks about utilisation of the XWB. Can you give an indication of what's going on in terms of utilisation for the other models? So particularly the Trent 700 I'm interested in, and Trent 100. Trent 1000 is the first question.
Yeah, so I think Trent 700. The older you get, the less utilised you are. That's the basic rule of thumb, and it's really quite difficult to generalise much more than that. Very, very approximately, Trent 700 is about half the utilisation rate of XWB at the moment. XWB and Trent 1000, the A350 and the 787, these are the aircraft that are getting used most in the wide-body space at the moment. And then when you get into A330s, used less. When you get into the older aircraft, then it's used even less.
Alright guys, that's the end of part 1. Please hit like and subscribe if you enjoyed it, and I will bring you part 2 as soon as I can. These videos take a while to upload because they're so long, so I will get it up as fast as I can. Have a great week trading, guys. Stock Surfer signing out.